Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we complete our final show on our contrarian view that both the rebound in asset and material prices and the enormity of financial support pumped into economies is now going to spill into the potential for higher levels of inflation. If you've only just tuned in, feel free to check out our two previous shows on the topic, where we covered issues that caused inflation in the 1970s and how the rules have changed since then. We had a look at technology being inherently deflationary, net result, a financial system over-engineered to prevent inflation. We also looked at the impact of China on commodity prices. As a behemoth in demand for global commodities, it makes a lot of sense to consider China's fortunes going forward when forecasting inflation. Well worth a look if you haven't already. Last week, we looked at the inventory supercycle. First, we looked at how an inventory cycle disproportionately affects manufacturers both upwards and downwards, and we're in the up cycle now. In addition to the usual cycle effects, retail demand has been juiced by a mix of stimulus checks, lack of services, and pent-up savings. Consumers have been spending on goods because they could not spend on services. Manufacturing supply has been limited by COVID, the Suez Canal blockage, and changing demand patterns. But inventory cycles are short. The price signals of today are building the excess capacity of tomorrow. The signs are good for economic growth, but are not indicative of rampant inflation. So now's the time to put all of these drivers into practical portfolio action. Today, we're going to run through several scenarios and strategies we're employing to both protect portfolios whilst taking advantage of the opportunities found in this contrarian view. Joining us today for the last of a big series is our Chief Strategist, David Llewellyn Smith. Hello to you, David.
G'day, Tim.
And also here to share his thoughts on our take on inflation risks and how we reflect these in our portfolios, we have our Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
And just a quick reminder before we get started, if you haven't already, subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, and follow us on your preferred podcast platform. We also ask if you take a moment to click like on the video now to help our show grow. And for those listening in live, of course, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So we'll jump into our agenda for today. So we're going to kick off with now versus history. We're then going to roll across to commodity prices, the inventory cycle, then those scenarios we're talking about, and then finally wrap it all up with our investment positioning as well. So I'll hand over to who'd like to get the show started today. Damien, I think you're keen.
Yeah, I wanted to do a quick recap of sort of three.
Damo, you're breaking up.
I think we're getting some tech issues from Damien.
Well, I'll take over for now.
Yeah, maybe if you get us started, Dave.
Yeah, sure. Yeah. So, yeah, I mean, we've had our three rather preliminaries to this potty. And now versus history, in terms of inflation and whether or not these days it compared favourably to past episodes of high inflation, such as post-war or the 1980s, for instance, and our conclusions were that it's very different this time. We produced a chart that shows that if you look at it over a 2-year cycle instead of one, then in effect all you're really doing is getting a lot of deflation in year one and then a lot of catch-up inflation in year two, twice the inflation as it were, and so it all evens out over a 2-year period. And then there are, the many other structural differences between now and, say, the 1980s, where, we have a lot of disenfranchised labour these days, globalisation considerably more advanced despite recent pullbacks, much less powerful trade unions, much more powerful corporations, which is often referred to as monopsony, which gives them pricing power when it comes to wages, and so you don't get wage push inflation. And so our conclusion was basically that this is all supply side, which brought us to our second kind of contention in this large debate, which is that it was more or less driven by an inventory super cycle, which is that we've had this huge shock to the global economy, both in terms of a decline in activity, but also a restructuring of activity, because, as Tim said earlier, households worldwide were unable to spend on services and anything that was kind of people to people. And so goods demand went through the roof, juiced by stimulus. And then as we've started to come out of that pandemic, we've also had lots of pent-up savings to unleash, and more stimulus, and of course just people getting back to work, etc. And so that goods demand has continued to boom, and we've kind of modeled for you how an inventory cycles, when you get relatively small swings at the end user interface, say in retail, for instance, that actually amplifies through the supply chain back to wholesalers and then to factories, industry itself, with a huge multiplication factor. So if you were to drop demand 10% in 1 year, it ends up being a 60% blow to production. If you then raise it 10% versus or back to normal even, you're going to get a huge kick to production above normal levels. And if you were to raise it even further above where you were before you had the shock, then it's going to be an enormous kick to production coming out of your problems. And so, while we're still in COVID, and we've got some supply side constraints around transport and commodities and other stuff, and then you've had this enormous inventory cycle, then inevitably you're going to see some really big price rises over the short term, simply because factories are going absolutely like the clappers, like they've never seen demand like it. And so that gives you, a lot of what we're seeing, for instance, in China with its producer inflation that was out yesterday at a extraordinary 9%. But if you look into it, it was really down to a couple of small things like iron ore, oil, a little bit of base metals, and a bit of mining. So it was just this enormous industrial super cycle that's just come pouring through and then juiced commodity prices that are inputs into that. And then you've had markets overlay that and start to extrapolate these prices out forever. And then Wall Street's telling everybody to buy commodities to protect against commodity inflation, onwards and upwards. But all of it is a relatively short-term phenomenon. And particularly, this is the case when you address our third component to this, which was the China problem, which is that China consumes anywhere between 50 and 3/4 of the volumes of global commodities, and because it was into this crisis first and out of it first, in particular with its stimulus as well as clearing up the virus, it's now tightening. It's into actually a normalization cycle ahead of everybody else, in particular targeting commodity-centric areas of its economy, because it hates Australia for one, but it also hates paying, very high prices for commodities, and an awful lot of them come from Australia. So it's a very annoying circumstance for the Chinese authorities, and so they've been tightening quite firmly on property in particular in China. They've been going after their property development sector, which is...
So, Dave, when you say going after, you mean like macroprudential style going after?
It's actually regulatory in terms of the property sector or the development sector, where they've put a whole... call it macroprudential, I guess, but it's not banks, it's developers. So they've just imposed a whole bunch of leverage limitations on them, in effect. And so, these huge developers used to just go out and borrow trillions of yuan, build ghost cities, and then flog them off over time with enormous inventories. And now they can only build on forward sales.
Yeah, right. Wow.
right? And so what that's forcing immense deleveraging into that segment. And so Chinese floor area starts have fallen heavily already over the first half of this year. Now, there's a pig in the python we've described in China, where the previous stimulus and catch-up growth and whatever has still got very high levels of activity, but it's going to pass, and this tightening is going to come to bear over the next 6 to 12 months. So that pops your commodities bubble. Then that flows back down into the supply chain stuff, just as the inventory cycle comes off, the super cycle, just as the economies reopen and goods demand starts to normalize because people can spend on services. And so this entire wound up thing that we've got, that lots of people are extrapolating into eternity, is just going to pop.
Yeah.
So that's why the Fed is, comfortable that there's no inflation coming. Most central banks, in fact, are comfortable that the inflation we're seeing is temporary, and basically we agree with them. In fact, I actually think there's a bit of an air pocket for growth developing in China. There's possibly one coming in the US as well, because a lot of its fiscal stimulus is rolling off. And so I actually think it's plausible that we'll see prices bust over the next 12 months, not just come off heavily, but actually bust. But, that's probably a risk case, but it's definitely there. Nonetheless, we certainly see very serious retracements of a lot of the supply side price rises we've seen to date.
And the danger is, though, that we are about to see some really strong inflation numbers come out of the US, and you're probably still going to get to see another couple of months of this in strong inflation numbers. The danger you have is that some central banks fold in the meantime. Is that they start under the pressure of seeing some high short-term headline inflation numbers, is they actually go the wrong way and start to tighten, or at least start taking steps towards tightening. So so that's probably one of the major risk cases which we're looking out for.
Yeah. So that kind of wraps up what we've been talking about for the last 3 weeks. And in the last week or so, markets have really started to sort of roll towards this view as well. We've seen some material falls in bond yields. Excuse my 5-year-old. Just hang on, I'll close my door.
Sorry.
And so sorry, do you want to go to?
No, I was just going to say, just sort of following on, we were sort of chatting before the show. You guys have come out with this, quite involved piece over, the course of the last few weeks, and it's just interesting to see that the rest of the world's sort of catching up and following the, getting on board with the same narrative.
Well, I wouldn't say that. There's still an awful lot of inflationistas out there, but the pricing in markets has definitely moved towards this narrative. That's a really interesting phenomenon, actually, which I find it hard to explain just in terms of, people talking their book or whatever. Like, there's a real inflation. There's just a group, I think, of heavy-hitting investors that are just really inflation paranoid. And they're very loud. They get a lot of headlines, and I guess they're talking their book. But they're just, we even forecast this earlier in the year. We thought that this would sort of take the imagination of certain segments of the market. But I don't know. I've just been a little bit surprised at the ferocity of it in certain quarters.
Yes, I mean, we positioned our portfolio for rising inflation, despite the fact we thought it would only be a head fake, but with the view that the market would, as it typically does, it takes short-term trends and extends them to infinity. And so we're, rather than sort of saying, yes, we do go through cycles, and so but as I said, it's surprising how despite the fact we're expecting it, it is surprising how vehement many of them are. And
so it's, I guess that's a bit of a lesson for everybody. This is our second pretty serious rotation in 6 months. And we'll go through our investment scenarios shortly. We probably see this discussion playing out for the next 12 months, 18 months. And so we're not fixed to any view here, because once we get through all of these distortions that are caused by COVID, which is what we're really talking about, COVID and its redress, and we get to some sense of normalcy, we are still going to get back to, relatively low unemployment in the US and in many developed markets, and in the US at least, not so much elsewhere. We are then going to have a lot of ongoing fiscal stimulus. So, the next tranches of that are the Biden infrastructure stuff, and that's going to get through in kind of September this year. But because it's not shovel-ready stuff, it probably take 12 months for it to really start to flow through. So it'll really be a kind of 2022, 23 story. And then you will get stronger US growth in this cycle as a result versus the last, and probably some higher inflation as a result, like better wages growth and good inflation. So, looking out 12 to 18 months, there's another rotation coming down the pipe here as well. But for the time being, we think that there's a pretty decent disinflationary shock coming. And the question is, how does that affect the market, and could it also turn into a growth shock for the market? Yep. So I'll just, I guess, go through our three scenarios for how.
Actually, just before we jump into that, and we've got a series of questions as well that we'll run through. But so obviously we've got a pretty important inflation print coming out of the US overnight, our time, tomorrow morning as well. Just some expectations around that, or if there's any commentary from you fellas.
A big number.
Yeah, I mean, the market consensus is for 4.7, I think, up from 4.2. Now, a chunk of that, about 0.3 of that at least, is actually just the fact that the base got smaller. So as you went from April to May last year, inflation actually fell. And so even if prices went nowhere, you'd expect prices to be 4.5. So, 4.7 I think is reasonable. I guess what I'd say is it's good somewhere between 4.4, 4.5 and low fives. I wouldn't be surprised with any of that. But I think that's where we're saying, it's certainly not impossible that you could see a number with a 5 on it, depending upon what some of those weird smaller categories do.
I've seen much higher modelling than that too.
Yeah,
I won't be surprised if it's a big number.
Yeah, and that could cause sort of this peak concern. After that, the base numbers start to rise, so you sort of year-on-year effect fades away. A lot of it is going to be down to where it is, though. And we've spoken before. We dug into whether it's the sticky prices or the not sticky prices, whether it's which segments are the ones where you're seeing big increases. If it's things like last time, it was sort of things like used cars and airline tickets and hotel rooms and things like that were actually already depressed in price. Well, certainly, hotel rooms and air price tickets were still below where they were sort of pre-pandemic. It was more just a bounce back. Those ones we're not as concerned about. If you start seeing some fundamental inflation come through, then yeah. But I mean, a good example though as well, just in how we're seeing this is we saw the Chinese inflation numbers came out earlier on in the week, and while the producer price index, which is the sort of factory gate price, was up almost 9% over the year, the consumer was sort of closer to 1%, and I think 1.2 or something, Dave.
It might have been 1.3. Yeah.
3, yeah, but low numbers, and particularly for China. And so it's that the thought that China is a fair bit further through the process than a lot of other countries, and it's just because you're seeing high prices back in the producer price doesn't actually always mean that it flows through to consumer. And actually, in recent years, it hasn't flown through to the consumer side.
Yep. Okay. All right. Very good. A couple of questions here, and thanks to our live listening audience. Feel free to stick in a few more if some come up. One here from TS. How does the seemingly large change in where we finally have the fiscal policy required for growth in the EU, Australia and USA that has been required after a decade of austerity change your view?
Well,
don't fight the Fed in not so many in too many words.
No. Well, I just go back to what I mentioned before, that we're, our current disinflationary shock, if you want to call it that, kind of scenario or thesis, is short term, well, short to medium, like depending on how you define those. So 12 to 18 months, and then that fiscal stuff starts to roll out in the US. Now, this is a really, really interesting question. I don't think the stuff in the EU is all that big, or all that relevant in terms of the kind of inflationary stuff that we're seeing today, and neither is it in the US. This is the really interesting part about it. Like, take the US, for instance, of a mooted $4 trillion in stimulus over like 8 to 10 years, only about 600 billion is hard assets. Right. So if you break that down to, say, the impact on steel, it ends up being like 6 to 10 million tons a year. Now, that's just so small that it's kooky.
0.3 to 0.5 of world demand.
Yeah.
So,
whereas if China succeeds in slowing its property sector or infrastructure, its infrastructure alone is 10 times that. Right. If it succeeds in slowing either infrastructure or property or both, then those they're just irrelevant to commodities. So the really interesting thing about this is we think that China's basically running out of rope for urbanization.
Okay.
So it is being forced to slow its construction sectors structurally, and this will be an ongoing process. It won't be all happen at once. It'll likely happen the way it has before. There'll be like put the brakes on, then hit the accelerator again, et cetera, as they're managing interest and growth and stuff. It's not all just at once, but it is an ongoing need. And so it means that China's growth is going to continue to slow over the coming cycle. Like, by the time they get to 2030, urbanization's done. They've only got 10 years of it left. It gets them to around 80% urbanized population, and that's just typical of a developed economy. Not many get higher. Some do, but not many. And a continental economy like China is unlikely to go much higher, I would think. Now, there are other things they could do. They could keep knocking down buildings and rebuilding them and stuff, Soviet style, and no doubt there'll be a lot of that too. But they are aware that this is going to slowly but surely strangle their economy if they don't deal with it. So
and the whole knockdown and rebuild process at the moment, you're knocking down a hut in a rural area that doesn't have any steel in it. But once you do start having to knock down buildings that already have the steel, all that will be recycled and put back into the new building.
Quite right. So back to your question, you've got fiscal spending that's going to give you a lift, especially in the US, a little bit in Europe. Europe's still going to be a very externally driven economy. It's not enough there, but it's bigger in the US. And so the US is going to be kind of the growth locomotive of the cycle, while China is the caboose. This is kind of the metaphor we've been using of late. And as China slows and the US accelerates. So that's not a very good scenario for commodities, even though you've got lots more fiscal stimulus, because you've basically got US inflation, growth, and interest rate leadership in that scenario. And that's a rising US dollar. And you've got slowing Chinese growth and commodity consumption that's much, much, much like magnitudes larger than what's happening in the US. And so you've got rising US dollar, which is really negative for commodities in financialization terms, and falling demand for commodities coming out of China. So the upshot of that in terms of inflation is it's nice and inflationary, a little bit inflationary for the US, and it's really deflationary for everybody else.
Yep.
And so it gives you this really interesting kind of challenge for all macro managers as we go further into the cycle. So that's my long-winded answer.
Thank you for that.
I've got one other thing to add to that is there's this whole part about monetary policy versus fiscal policy, and for the last 15, 20 years, we've been saying we're going to fight. We're going to try and get our inflation up by using monetary policy. We've got our fiscal policy sort of tied behind our back in terms of saying no, we're going to reduce. We're either in Australia running down the deficit, or in the EU, not running deficits greater than X%, and in the US, depending upon whether you've got a Republican president or a Democratic president, if you've got a Democratic president, you tend to have all of a sudden a whole bunch of people worried about the debt. And so it's this thing we've been saying, let's try and get inflation higher, but we're going to fight it with one hand tied behind our back. And now we've come and said, okay, now we're going to use both arms for a little bit. Like we'll have a few jabs, and then, but the question is, will that hand go back behind the back again as you start to come out of this? Do you start to see, like already we've had one high month of inflation, and we've spoken about the amount of inflation hysteria that's out there about, this is it. We've had one high month. It's all over, pack it up. It's hyperinflation is the next step. Yep. And it's saying, well, is that going to die down, or are people going to ignore that, or are politicians going to keep up with the fiscal spending? Now, at the moment, it does look like they're going to keep up with the fiscal spending, particularly in the US, but it's an open question, and until we actually do see a number of months of inflation and see what pressure builds on these politicians, it's quite likely they will just go back to saying, okay, well, let's just go back to trying to fight it with one arm again.
Okay. Yeah, very good. Another question that's come in. Thank you, Alec. And this might be a nice segue into our next slide. Beg your pardon, here we go. If you positioned for transitory inflation, what were your sell signals on these positions? Bonds, central bank messaging.
A couple of things.
Sorry. Well, there's a whole bunch of them. There's heaps of them.
Yep.
But I mean, my key ones were sorry.
When your kids came in.
Yeah.
Kids.
The
joys of lockdown.
I think a lot of the investment universe is very US centric.
Yep.
And thinks that the Fed, and this is probably just a legacy of monetarism that everyone's been taught for the last 30 years, that the Fed is the be-all and end-all of inflation. And yet, if you look at the reality of it, it's really Chinese demand for commodities that is the be-all and end-all of inflation for the last several cycles. We've never managed to get any decent wage inflation anywhere to get a wage push inflation cycle going. And most of the inflation that we've had, pulses that we've had coming out of shocks and going into them, have simply been commodity based. And so what China does with credit is more important than what the Fed does. So my key signals have been watching what China's doing in terms of credit. And that's, their credit impulses rolled over 6 or 8 months ago. It's really been plunging for the last 5. And if you chart that against really basic indices like the CRB or any kind of commodity index, the correlation's there to see.
Yeah,
it's very, very simple. Before you even get to things like iron ore that are much more precisely kind of correlated, where the levels of consumption in China are just off the chart. And so China's been the key for me.
Okay. Yep.
Yeah.
Damien?
Yeah, look, I'd echo that one, but I think as well, pricing's obviously important to us. Is that the bond, watching what the bond market's doing. If the bond market had it backed up even further, we would have been overweight bonds and picking up more long-term bonds. We'd sort of, I guess I call it hiding it. We'd hidden at the short end of the curve, and now we're starting to normalise our positions in terms of saying, okay, well, let's go back to a more normal bond condition, because we have seen bond yields rise, and actually in the last week they've started to go back the other way. And so, the bond markets really haven't priced in as much as equity markets has. The bond markets are sort of, they've really treated it as, look, this inflation is, there's a bit of inflation, but it looks like it's going to go away. And certainly when you dig into some of the pricing of things like, you can sort of get a read in terms of what investment markets are actually pricing inflation at, and very much they're pricing in. Yes, there'll be short-term inflation, but the long-term inflation outlook is actually pretty low. The equity markets, so seeing where the equity market rotations are happening, that's another thing. So for us, it's saying, well, if we're expecting this inflation scare and we see the market start to take too extreme of a position, saying yes, inflation is coming, then that's a good sign for us to then be able to flip, sell at the higher prices and be able to flip back into the lower prices of stocks where we don't think we think they'll benefit from the disinflation. And so so pricing is. There's a fundamental side to it, which is where do we see the fundamentals? But then the second part is where do we see the mispricing? Because like the bonds. So for us, fundamentally we should be longer term bonds, but actually they're not really that mispriced, and if anything, they're sort of maybe a little bit conservatively priced at the moment. So so that's an asset that fundamentally we'd like to be buying, but we're not, because the price is not at an appropriate level.
Okay, all right, very good. All right, so let's jump across to our investment scenarios, gentlemen. So we've sort of got three rough paths in front of us. We'll go through them one by one. Good news is good news, bad news is good news, good news is bad news.
So good news is good news is inflation falls. Well, let's sort of start at the beginning and say the supply side frictions start to ease, and so some of the cap on production that's developed in recent times lifts, and output can lift, but at the same time commodities come off in price as China slows, and so you get a margin lift for corporations, for businesses, right? And so this is good for profits. Sorry,
and assuming wages stay low as well. So
yeah, I mean, like there are similar dynamics playing out in some labour markets, like in terms of, I don't know if you could call it an inventory cycle exactly, but I mean there are supply side frictions in the US labour market. I think it's fair to say at the moment as well, and they'll ease as well. So we're going to see some wage inflation initially. I think that's going to ease as people become more comfortable going back to work. The vaccines are more effective. All the unemployment, special unemployment stuff rolls off, etc., etc., etc. So yes, we expect wages to be fine for the time being. So that's just a basic good news is story. If that's the case, then you can sort of be relatively sanguine about equities. Excuse me, and you're kind of looking at a kind of mid-cycle rotation to quality. Pretty typical of a normal cycle. Everything's very overvalued, so there might be a correction, but it's not too dramatic. And you wouldn't see enormous falls in bond yields, but definitely some. So that's your first scenario. Second one, bad news.
Well, actually, let's talk about a bit more as well about that one, because this is one which I think we're thinking of as a pretty likely scenario. So the types of assets we want to own in that type of scenario is we're sort of looking more as a little bit of a barbell type strategy in terms of that. Is some defensives, and defensives you're sort of talking about utilities, REITs, telcos type stocks that have got this interest rate comparability. In that usually what happens is interest rates falls, they do quite well. Within the REIT sector in particular, that's one where so real estate investment trusts is there are still some concerns around vacancy rates and what does the office actually look like going forward. So as an example, within our own portfolios, we actually don't have very many of the sort of traditional office REITs or things like that. We've sort of gone for more esoteric ones. So we've got some storage REITs. So sort of with the idea that people have bought all these goods during the pandemic and they're going to need to put them somewhere. There's actually the world's largest REIT is American Tower Corporation, which effectively owns towers and leases out the communications to telcos, effectively sells to telcos the spots on that tower, and that's quite a good growth area with 5G and everything like that, sort of with the rollout. And so there's ways like that where we're trying to find sectors that aren't as exposed to that property market, but still get that same sort of defensive exposure. So that's sort of one end of your barbell. At the other end, some people have chased the really high growth sort of junk qualities, the ones where you're loss-making stocks where your idea is it's going to the moon, and they'll probably do all right under this scenario. But we tend to prefer to go for some more of the quality end of the growth, where you get sort of stocks like your Facebooks and your Googles and your Microsofts and Apples and stocks like that, where you're getting decent growth or quite good growth out of them, but there's a much higher quality because they're actually earning good profitability at the same time.
There is a risk as well when you're going into the sort of crappy growth area of the market, the one that basically blew an extraordinary bubble last year. That bubble's only half deflated, and so it's possible as well that if you get a good news is good news scenario play out, then the market could start to look through to possible inflation in 2023 or whatever, and the markets simply may not bid back into that bubble. It may continue to deflate because some of the valuations are still pretty wild there, even though we have had a pretty epic bust. So we're not interested in going, in being Cathy Wood of this world and chasing the more speculative end of the market. That said, that kind of segues into our next scenario, which is bad news is good news, and that is, if this unraveling we see on the supply side prices, not necessarily output, if that really does bust, as I suggested earlier, it might, then and we get a real, if bond yields really get beaten up, because what we could see is, just take iron ore as an example. Let's say it falls by half over 12 months, and so your 9% PPI this year in China will become minus 6% next year. You'll reverse all of the base effects that are panicking everyone right now, and they'll all be panicking about deflation instead. And in that scenario, then you really do want to own more bonds, be much further out the curve, and we could actually see another wild rotation back into all of that growth schlock that did so well last year. The speculative EV stuff, the non-profitable tech, SPACs, Bitcoin, that whole kind of crazed, somewhat, if we get that bad news is good news scenario play out.
And it's worth
Damo,
noting
you want to add
those ones. Yeah, the thing I wanted to add on those ones is both these scenarios, as we've said, some of that low quality tech, your Teslas and stuff like that could perform quite well. It's worth noting though, it's your everything's got a risk and return, and so we're talking about different scenarios. And in some cases, you're saying, well, okay, here's a stock where if this happens and this happens, it could be up 10%. And then you look at a different scenario and go, well, if something slightly different happens, this could be up 30%. But on the third scenario, when you go, well, yeah, okay, but if things go wrong, this thing could be down 90%. It's like all of a sudden you're like, okay, well, yes, there's a little bit of upside in a couple of scenarios, but there's this massive downside. And even if you don't take the, even if you get it wrong and you sort of said, I'm not going to invest in this stock, and it does go up 30%, it might not have been a wrong decision if things were quite uncertain. And you're saying, well, your downside was you're going to lose a lot. It's sort of a bit like, you turn up to the casino and you say, I'm going to bet on red or black. And on red, I'm going to double my money, and on black, I'm going to lose my house. It's like, well, okay, well, if I'm putting down $100, and I might earn 200, or the downside is I lose my house. You're like, well, okay, not playing is often a good bet. Is often a good strategy.
Yep.
And even if it comes up and you go, well, I would have actually doubled my money. He's going, yes, but I avoided the chance to lose my house. So with some of these, the high growth area. it's what I think Dave's been trading possibly a tradable rally if you're in and out quickly, but it is it's a high risk area to be playing in, especially now as that bubble is already deflating.
Yeah, it would be a bear market rally basically. So then there's our third scenario, and this is the good news is bad news model, which basically transpires if as well as price falls, we actually see a bit of a growth shock. Now that's possible because for two main reasons. We're about to see Europe reopen, aggressively, and that's going to be terrific support for this, for the global economy, and to ensure that as China and the US come off, that there's more growth in the global economy and in this inventory cycle. But China is going to come off, and how the timing of how those two things transpire is not entirely clear. China's definitely going to come off, I think, starting in the second half of this year and more in 2022. And I think a lot of it being very commodity centric means that it can flow on. You can get contagion effects from that into things like emerging markets. Like if we really get a big commodity rout and emerging markets get drawn into that, then you start to see things like junk bond spreads blow out, and then you start to get a rising US dollar, and then those dynamics can feed on themselves for a little while, and the whole world kind of suddenly thinks, well, we're into a China growth shock. Now, the second reason I think that is not implausible is because the US is also going to slow a lot by the end of this year. Its reopening is going terrific. Its labour market will continue to rebound. All of those things are true. But it poured so much fiscal stimulus into the dark days of the pandemic, quite rightly, that it's a simple mathematical issue where they're going to be, they're going to be pulling out like $7 trillion of stimulus year over year. And so you'll get lots of private sector reopening, and that's going to be great for activity. But there's a huge headwind here of public spending that's just going to get sucked out of the economy. And so it's going to go from 10% growth in Q2 to nobody really knows what it'll be by Q4. I've seen anything from 0 to 4 or 5.
Wow.
Now, and it's temporary, right? Because it's just the fact that when these $2 trillion hits of stimulus come out in a quarter, 12 months on, they're not there.
Yep.
Right? And so that's just a massive rate of change in your public spending that directly comes off your GDP, and that makes corporate profits difficult. So if you get, and I'm not saying that this is going to happen, I'm saying it's plausible. You could get that combining with a China slowdown and fighting against the European reopening in a way where there's actually a mini growth shock coming as the whole supply side starts to unwind this coiled spring. And in that case, you could very easily see a reasonably decent correction in equities.
Right. And also the other thing we spoke about was the traditional inventory cycle, where you see that very much come through, that you get at the manufacturer, sort of you have to have a look at the one from last week or have a look through the version online. But basically the manufacturer goes from, say, producing 90 units per month to almost doubling their production for a month. But then it actually might fall back to 110. So you're still well above where you started from, but you've been through this big jump first. And so it's just a slowdown from, jumps from, say, 90 to 150 and then back down to 110. Your 110 is still better than the 90 it was running at, but you've had this massive growth sort of bring forward where people have had to do the restocking. And so that's what David's talking. Part of what David's talking about as well is there's just you can see, it's not a base case, but you can certainly see where a number of these things could just all line up together, all coming through at the same time and just turning into this growth shock. And at the same time, if the inventory cycle has lasted another couple of months longer than what we think, you might find a few more central banks starting to tighten, and it's just like it goes from being hey, isn't everything wonderful, to suddenly everything's looking quite bad, and as if there's been a policy error all within a short couple of months. And so as you're saying, not a base case, but certainly on the cards as a possibility.
Don't get me wrong, I'm not saying, even if this happened, it's not a scenario in which you get like a massive crash in the stock market. It's a scenario in which the stock market simply has to remind authorities that that it's very highly valued and hanging on policy stimulus.
Yep.
Right. And so it's just one of those cases where you got to fall 10 or 15% until the Fed promises something new, and perhaps China as well.
Yeah, it's just markets just want central banks to tell them that they love them again.
Yes.
Yeah. Remind me that you love me, and then they can say, oh, "Okay, that's right. I can." And so that's that whole. We spoke about markets at the moment extrapolating things to infinity, which is what they tend to do on both the upside and the downside. Is that when things are good, things are always going to be good, and then when things are bad, things are always going to be bad. And so so what we're saying is that we've got this good section right now that markets are thinking are going to be good forever, whereas we're saying no, there's a bit of a growth hole. But by the same token, when the growth hole happens, that's a buying opportunity, because when the markets are saying, oh, this is going to growth's over, we're all headed to be you'll never see growth again.
If that happened, it'd be a fantastic buying opportunity, because you're then going into next year's ramp up of Biden stimulus and terrific US growth. So yeah, I mean, I'm not saying I hope it happens, but it would be a great buying opportunity if it did. So if you're into that scenario, you would want to be thinking about the same things that we've already described in terms of factor rotations for your equities, where you're looking in terms of what Damo described, but you'd want to be holding less of them as well, and more longer bonds, longer duration bonds. So, but that said, as I say, I don't think this is any sort of large end of cycle event or anything. It's just pretty typical mid-cycle correction that is a good chance to rotate or get longer for what looks like, once we get through all these distortions, will actually be a very good cycle for the US and a more troubled cycle outside the US.
Okay, very good. Just a quick one, I guess, on just looking locally. I know we've been sort of speaking in a very sort of global piece, but is there sort of any point of difference, do you think, with the Australian economy over everything else, or are we all sort of falling into lockstep large off the back of the China thematic?
Look, it depends what you look at. Like, this week we had the NAB business survey come out in Australia, and it was just the wildest survey I've ever seen, I reckon.
In what way?
It was so overheated that it looked like the RBA should hike rates by 100 basis points next month, right? But so many of these indices are being distorted by COVID, and a lot of these effects that we're talking about, base effects, PMIs are terrible in this environment. I think that's what's impacted the NAB survey as well a little bit with its year-on-year comparisons. That's why inflation looks so high. We've described this ad nauseum. But if you read some of the indicators in the Australian economy, they're absolutely eye-popping at the moment. I don't think there's any doubt that right now we've got a solid, good recovery going with good momentum. Like house prices are mad. The government's triggered a lot of bring forward in capex through its tax incentives that really interesting. We don't think they'll be needed because we're going to be in oversupply again shortly. But for the time being, capacity utilization is really high, and it's going gangbusters. We got iron ore, high terms of trade, heaps of income growth. It's all great. Closed borders, possible wage rises, etc. But once you, at a certain point in the not too distant future, they're going to have to tighten on house prices, just for financial stability reasons, maybe a year away. And then you've got all of this China action coming down the pipe, which is going to do a lot of damage to terms of trade. Will really hit national income, hurt nominal growth, hurt the budget. How will the government respond to that when the deficits that it's blithely forecasting for the time being are all improving because of iron ore, but when it goes the other way and they start deteriorating badly, will they go back to more austerity? There are a lot more challenges coming down the pipe for Australia, and then of course the unknowns like the vaccine, getting our borders back open, and then are they going to drop another immigration bomb on us for the next 10 years and wipe out wages growth again? I mean, a lot of unknowns.
Still, that seems fairly far off given the low levels of vaccination in the country. So
well, it's probably a good 12 months away, I think.
Yeah.
It sounds like as well, David, if you were giving advice to our current PM, you might be suggesting an earlier election rather than the later election would be beneficial for him.
I think
economically.
Look, probably, because I mean things are going pretty well now, and the further out you get, the closer you are to tightening on housing and
iron ore falling.
Yep. And so probably, but his polls aren't great, so we'll have to wait and see.
We've got another question here from TS. So you give little weight to the argument that the ESG crowd are going to limit future capex expansion exploration on energy, so that's oil, coal, etc., while demand still increases in China, India, and Southeast Asia. And he's just used an example, or he or she has used an example that for every gigawatt of coal turned off in the EU and the US, it's replaced by 3 gigawatts of coal energy in Southeast Asia. So is there sort of anything noted in that?
There's a little bit of this already in US oil with the Biden administration in power, crimping shale a little bit. So I don't completely discount it. And one of the more interesting and complicating factors on my commodities bust thesis is oil. I mean, at the moment, it's just a thoroughly manipulated market, but effectively so for the time being. OPEC's still got over 6 million barrels off market. Shale's got about 2 off market from previous highs. The EIA is forecasting maybe 30% of that comes back over the next 12 months. OPEC will drip it in as needs be. Then you got Iran with another 2. I mean, there's oil everywhere to come back into the market. And I think that's a couple of years worth until you really see any ECG effects. But I could see if OPEC, plays it tough, we might get oil up a bit higher.
Yep.
In terms of coal, I mean that's a tough one. Off the top of my head. Sorry, go on, Damo.
I was going to say one of the big differences with coal is coal mines tend not to see steep declines every year. So oil, particularly shale oil, has steep declines every year, but even normal oil wells do decline every year. So if you're sitting with just today's production, it's going to be lower tomorrow. And so you need all those, and so you do need that renewed investment. Coal is a bit different in that the production tends to be quite steady and if anything, increasing from individual mines until one day it suddenly stops. So it's not quite the same. Not quite the same effects.
I'd just simply say in response, remember we're talking about a scenario for the next 12 to 18 months. And so if you're talking ESG, you're talking long-term impacts. So we've got a bit of a horizon mismatch on that question.
Yeah, and I think as well, so part for, say, coal is about saying, well, if you're trying to invest in coal because you think that ESG guys are going to stop new coal mines and there's going to be a demand still, and so you've got this short-term window where you'll be able to make these super prices, is if that's what you're basing it on, then there's a chance you'll be right. But if you want to be pretty careful in your model though as well, you're not sort of sitting there going, yes, I've got a mine with I've got a 70-year mine life here, and I'm going to make super profits for the first 3 years, and then you're not factoring in that you might not even last 70 years. You might only last 20 or 10 years in that mine before you're not making any. And that whole part, we've got our solar power and our sort of charts up there that we show, but it's very clear that solar plus battery really puts a lid on in terms of prices. And so where your prices just don't go higher than that solar plus batteries. And so the days of seeing coal prices increase significantly from here, I think it's going to be very limited short-term supply demand imbalances. It's not going to be any there's no sort of long-term thesis in it. You should be certainly factoring in lower coal prices year after year.
Yep. Okay, very good. Just in the interest of time, I've got one last question here from Tom. Quite a long one. I'll just bear with me. So thanks, Tom. Can you please explain why we can't have government-induced inflation with relentless government spending and subsidies, with the zero rate hikes, and with the RBA stating it will bust asset bubbles? That is my base case, that the RBA will never raise rates whilst government spending and regional wars will create inflation that is never fought with rate hikes. Can you please explain how this won't happen?
Okay, so
the real question is, will governments keep on spending? I think in the end. So would you say could I see a scenario where governments keep spending and you just don't see rate hikes of any significant magnitude? So basically, you're looking at Japan. Basically, saying could you see a whole bunch of countries turn into Japan? Absolutely. I can absolutely see that as a scenario. Now, though, it's a matter of saying, will you get enough impetus behind sort of MMT or sort of real big spending type pushes that actually say we're actually going to get enough money out there to create inflation and push even harder, so that push hard enough so you do get inflation and then you can have rate rises? Or the flip side is, will you also, or could you possibly have governments after a year or two of spending lots of money to decide, okay, we've done enough now. Now it's time for the central bank to sort everything else out. We'll go back to austerity or try to balance budgets and things like that. And so, of the three scenarios, look, I do think the Japan version, I guess, that he's sort of saying is the middle version, which is governments spend enough money but not enough to generate any meaningful inflation, and so central banks sort of stay on hold or not doing much. I think that's a pretty good base case, but you have to acknowledge that the upside and the downside is definitely there as well, and trying to work out which one's going to happen, I think is only something we're going to know as it evolves over time. So sort of social science, there's nothing you stick into a model and spit out the answer at the other end. It really comes down to a political decision about budgets, governments running big budgets, will that be accepted or not?
Well, I think, and that's sort of part of it, isn't it? He's saying that with the government's raised or heightened rate of spending, the RBA's hands are tied, because at some point that'll come, potentially come back down again, and then they'll be stuck with or they could be accused then of perhaps blowing up the economy, as opposed to the fact that the government's not spending. So anyway, very good. All right, guys. Well, look, thanks for a great show. A nice capstone to a terrific piece. We've got an exciting bit of information coming through in the US print tomorrow as well. So we'll stay tuned for that. It might be an article dissecting that one as well, perhaps coming through on the channels, Damien. Maybe in a podcast.
Yeah, absolutely. Yeah, we'll certainly have a look at those, and depends on how different it is, whether we talk about it next week. But it'll be actually, no, we've got a guest on next week, haven't we? But it'll be I think we'll certainly be writing something on it, just to sort of reflect where it sits, and because the real thing for these as well is getting away from that headline number. We know the headline number is going to be big, but if it's sort of supported by, say, used car growth again or something like that, it's a much less concern than if there's a solid across the board sort of rise in a whole bunch of sort of more sticky variables.
Yep. Okay. Very good. Oh, well, thanks again, gents. And we've obviously got the capstone article out for anybody who wants to have a read of that, and we'll put a link to that in the show notes for the final piece in the big inflation series of the last few weeks. So thanks again.
Thanks, Tim.
Thank you, Tim.
Thanks, fellas. We'll just roll into a couple of quick slides as well. So we just thought we'd offer up an ability to have a look at a portfolio and obviously see how we have been putting these themes into practice, essentially in personal portfolios. And if you'd like, you always can head to nucleuswealth.com, go to the Get Started link, which just gets you into our obligation-free portal to have a look at the portfolios. And obviously we can provide advice and give a snapshot of what an investment could look like for you. One of the big things with what we do, of course, is transparency, and you can always see exactly what you own throughout the time of investing with us, and there's a huge amount of transparency and also tailoring in there as well, incorporating the themes like we've spoken about today. Our guest, our viewer question for the week this week is, what steps are you taking with your portfolio to prevent or limit perhaps a potentially bubble in inflation? And always interested to read those and check those out and reflect on those from our viewers as well. Of course, you can always jump onto our website and sorry, bear with me, I'm a bit stuck here. We go. The slide, there we go. But yeah, always looking forward to those comments. As always, of course, thanks again to those who've watched in live for another great episode, and to all of those that asked some terrific questions again today, some quite involved questions. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date on news from us, follow us on social media. And finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend, and help our show grow. So that's it again. So thanks for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one. Cheers.